Hi, I'm David Stein of Money for the Rest of Us, and this is a channel on money, investing, in the economy. In today's video, we're going to take a look at rebalancing our portfolios. How do we do it? Why do we do it? And when do we do it? What is the best method for rebalancing our portfolio? Let's get started. So for rebalancing, first, what is it exactly? It's when we sell an asset that we are overweight in our asset allocation portfolio. So we'll have a strategic target. Maybe we'll have a range around that target. As an institutional investment advisor, my endowment foundation clients, we would meet quarterly and we would look at the target and we would see if any of our assets, such as stocks, real estate investment trust, bonds, were outside of that target range. And then we might sell the asset that was overweight and reallocate those proceeds to an asset that was underweight. Now, it presumes there's a strategic target. Sometimes as individual investors, we might not have a target. We might just be more opportunistic, and we might adjust our allocation as we get cash flows. Now, why do we rebalance? Well, over time, if we don't rebalance, more volatile assets become a larger and larger percentage of our portfolio. And that introduces what is known as positive skewness and volatility drag, where as stocks become a larger percentage of our portfolio, those big losses in the stock market, whereas if you lose a 50% in your stock portfolio, you need 100% gain to recover that. Let me show you an example of that. If we think of a distribution of wealth outcomes, so not returns, but the actual ending wealth, a portfolio that is positively skewed means more of the outcomes fall below the mean or the average, like you see in that diagram. So we won't have as much wealth as we expected because of big losses and the amount of time and the higher returns it takes to recover those big losses. Now, with positive skewness, you get some returns that are much better than expected. But as investors, we only get one shot. We just have our portfolio. We don't have many different portfolios and different lives. We get one life. And so we want to make sure that our portfolio and its expected return and its allocation is in line with our risk tolerance so that we don't fall short. And by not rebalancing, we introduce this volatility drag, the drag from underperformance after big losses. And so we want to make sure our portfolio is in line with our expectations. Now, here's an example. If you have a portfolio that was 60% stocks, 40% bonds in 1927, given the strong stock market returns in 1928 and up until the crash, that portfolio would have been 76% stocks if it hadn't been rebalanced. And then with the crash by 1932, that portfolio would have been down to 32% stocks if it wasn't rebalanced. And then eventually with the recovery, it would have recovered to close to 100% stocks. And so just leaving a portfolio on autopilot can lead to some significant deviations from our target. Now, again, by rebalancing, we increase the likelihood of achieving our expected wealth outcome, the final dollar or euro value that we want. But there's some cost to rebalancing. If we rebalance, there's some potential underperformance. If, for example, the asset that we sold to rebalance is outperforming and it continues to outperform, and we allocate that asset to something that's underperforming, and it continues to underperform, the act of rebalancing will actually lower our return compared to whether we hadn't rebalanced at all. Now, that's just something we have to accept as part of rebalancing. But there's also some additional cost. Sometimes there can be trading costs, but in a world where many commissions are almost zero or free, that's not such a big cost. But there can be a cost in terms of taxes. If we sell an asset that is overweight and it's in a taxable account, we'll have to pay capital gains tax. And so we need to be mindful of those taxes. There's some spreadsheet on my website for Plus members that can help them work through that. But we need to at least recognize that that is one of the challenges with rebalancing, and be more sensitive to that in terms of the capital gains. Now, here's the different methods for rebalancing. We can use a time-based approach. So that could be monthly, quarterly, annually, or we can use a threshold-based approach. So we have an upper range, a lower range, and if a particular asset class gets outside of that range, then we might want to rebalance. Now, here's the most surprising thing about this video, or about rebalancing at all. When I looked at studies to see which method of rebalancing works, there wasn't one. It's amazing. You would think that all these different methods, different time-based methods, different ranges, that there would be something that would stand out. But that's just not the case. Let's take a look at some studies to see that. Here's one study that looked at data from 1960 to 2017. It was 60% stocks, 40% bonds, and they used different methods. They use a monthly rebalance method, a quarterly method, annual. They use a 2% threshold, a 4% threshold. And if you look at the third line from the bottom, it shows the return of that portfolio over that time frame using those different methods. And it might be hard to see, but all of the returns averaged 9.1 to 9.2%. And they all had similar volatility. So there really wasn't any difference. And even within these strategies, what they did is they might not have fully rebalanced. They might have only moved halfway to the target or a quarter of the way back to the target when they did their periodic rebalancing. And in that case, it still didn't make a difference. Here's another study from 1979 to 2019. Again, they looked at calendar-based, monthly, quarterly, annually, and then even the annual, doing it in December or doing it in June. They looked at different tolerance bands from 1% back to 10% and whether they actually rebalanced all the way back or not. And again, the return was between 10.4% and 10.6% annualized. Again, it didn't matter. And the volatility was the same. So what can we learn from that? Well, the method you use to rebalance isn't really that important. You have to choose one that fits your investment approach and your temperament, because sometimes rebalancing can be a little scary. If the market has sold off, the stock market's down 30% to 40%, and in order to rebalance, you have to sell bonds or cash and put it back into the stock market. That can be intimidating. And so sometimes having a specific method to rebalance, be it calendar or threshold, and just follow that religiously can help us control our emotions. Now, other investors, that doesn't bother them as much. And like the way that my approach is much more opportunistic. As I see opportunities arise, I might rebalance. I don't necessarily have a firm target for every asset class. I have some general risk tolerances that I'm trying to achieve. But overall, we could be opportunistic in our rebalancing. So, bottom line, rebalancing is important. You have to at least choose some method and rebalance occasionally. But that method and when you do it isn't really that important, as the returns won't be that different. But ultimately, if you don't rebalance, then you get some potential over-concentration. You get that volatility drag, and you might fall short of your expected wealth outcome. Hey, if you like this video, give it a thumbs up. If you have any questions or comments on rebalancing, please leave those below. And hey, subscribe to my channel. Click the bell if you want to be notified every time I do a video. Thanks.